All right, let's jump right in. Today, we're pulling back the curtain on the Forex market. And look, this isn't about some flashy new indicator or another complicated strategy. We're talking about a total shift in how you see the market, a way to stop fighting the current and start trading with the giants who actually create it. Ready? Let's get into it.
So let's start with a hard truth. 90%. That's the number of Forex traders who just can't seem to find consistency. I mean, think about it. You might have a good day, maybe even a good week, but the losses just seem to pile up. It feels like this constant uphill battle, right? And for most people, it's a battle they end up losing. The big question is,
Why is it so darn hard? Well, the material we're digging into today has a pretty wild answer. It's not an accident. It's by design. The market isn't just this random, chaotic thing. Nope, it's a carefully structured game. And that massive failure rate, well, that's just part of the rules. To really get this, you have to meet the architects of the game, the market makers. Now, these aren't your typical traders working from a home office. These are the big-time institutions on the other side of almost every retail trade. And trust me, they're playing a completely different sport. So what exactly is a market maker? You can think of them as the huge banks and financial giants that pump all the money, or liquidity, into the market to keep it moving. But here's the kicker. Their main goal isn't to guess which way the market's going to go. It's way, way simpler. Their goal is just to collect volume. They're collecting contracts. This quote from Steve Morrow really just lays it all out there, doesn't it? Their aim is to collect contracts. How? By triggering the stop losses of regular traders like us, grabbing that liquidity, and then boom, they push the market the other way. It's basically a hunt, and retail orders are the prize. Okay, I know that sounds pretty scary. It kind of feels like the game is rigged, right? But what if you could flip the script? What if, instead of being the one who's hunted, you could learn to follow the hunter? That's the question that changes everything. And the answer to that question is something called the order block secret. You see, if the market makers are these giants stomping through the market, well, they leave behind footprints. Our job as traders is to learn how to spot those footprints and just follow where they're going. So what is this footprint? It's called an order block. Now, this is not just any old candle on your chart. When you look at it from an institutional point of view, it's a massive clue. It is the exact spot where smart money loaded up on a huge number of orders right before they made their real move. Let's break this down. It's actually pretty simple. You've got two kinds. A bearish order block, that's the last up candle you see right before the price just tanks. And a bullish order block is the exact opposite. It's the last down candle right before the market shoots up. You can almost think of it like a head fake in sports. It's that last little move to throw everyone off before the real play begins. Now, you're not going to find these things just anywhere. You have to go where the market makers are hunting for volume. And where is that? It's at key, predictable price levels. Yesterday's high and low, the weekly high and low, the monthly high and low. These are like natural watering holes where stop losses and entry orders all gather, making them the perfect hunting ground. Okay, so we get what an order block is and where to find one. Now for the good stuff. Let's turn this into a super practical, step-by-step process you can actually use to find a solid trade entry. Here it is, 4 simple steps. First, you spot a clear top or bottom in the market, what we call a peak formation. Second, you check your location. Is the price sitting at a key level, like yesterday's high? Third, you pinpoint that final misdirection candle. That's your order block. And last, and this is so important, you wait. You wait for the price to break past that block. That's your green light. That's the confirmation that the big move is on. And to make life even easier, you don't need to stare at a dozen different charts. The source material says to focus. The 15-minute chart is perfect for those daily setups, while the 4-hour chart is your go-to for catching the bigger weekly or monthly moves. Keep it simple. All right, let's put this whole thing together now into a simple blueprint, like a checklist that you can use every single day when you're looking for these high-quality setups. This little cheat sheet breaks it down beautifully. On the 15-minute chart, you're watching for price to hit yesterday's high or low. The pattern you're looking for is often a classic M or W shape, a double top or bottom. The final signal, price breaking your order block. For a bigger picture trade on the 4-hour, your location might be a big round number. The signal here is often divergence. That's when price makes a new high, but your indicator doesn't follow. And again, the trigger is the break of that key order block. And maybe the most important rule of all is this. patience. This is not about taking 100 trades a week. It's about taking the right trades. Every single piece of this puzzle has to line up perfectly. You've got to have the right location, the right pattern, the right trigger. Fighting that urge to jump in too early, that's what separates the winners from the 90%. So I'll leave you with this thought. Maybe all this time we spend trying to find the perfect indicator to predict the future is, well, maybe it's a waste of time. What if the real secret to trading isn't about being a fortune teller, but more about being a detective? About finding the footprints of smart money and simply following where they lead? That's the really powerful idea behind this whole strategy.